All right, Stillwater, Oklahoma, we're coming at you with the ultimate home buyer's loan buying guide today. We're here with Dan, and he's going to go over these 9 top questions that all buyers have when they're buying a home in the Stillwater, Oklahoma metro area when it comes to the financing side and the home loan side. I'm so excited to bring you today's questions. Dan, how is your day? How is your week going?
Well, go Pokes, and I had to show you this. There you go. Go Pokes. It's going great. I'm excited about what we're going to talk about. I'm excited about the future for the Stillwater market. And I mean, these are going to be some great topics that we're going to talk about.
These are 9 questions that we got from Google that you home buyers ask about loans. So you're not going to want to miss out. Dan, the first question that comes up a lot of times when people are buying a home is, what's the difference between a pre-qual and a pre-approval? Is there one?
There is a big difference, and I'm going to keep it very simple. The majority of your lenders will issue a pre-qualification. Pre-qualification is you've submitted your application and they pulled your credit. And based upon the information you submitted in their credit bureau, they feel you qualify. So they issue a pre-qualification. However, in this market, a pre-approval is where you've done that, but you've submitted your income documents, your bank statements, your pay stubs, your ID, your driver's license, any pertinent facts, your divorce decree, your bankruptcy, anything. A pre-approval basically states that we have not only reviewed your application, we've confirmed it's accurate, and we've confirmed the information you gave us is accurate. So a pre-approval goes a lot, pre-approval bears a lot more weight, and a lot of real estate agents will not even accept a pre-qualification because pre-approval means we've actually looked at it. So it's huge. There's a big difference. And in this market, that is phenomenal, and it'll help you get into the house.
Wow. That's some awesome information, Dan. And unlike what the national media is saying about housing, Oklahoma still 4th most affordable state, still low inventory, and in some price ranges, we're starting to see multiple offers again. So being pre-approved with all your income docs verified is going to give you a step up against those other offers. Would that be a good accurate
1,000% right? Every real estate agent that I've talked to recently, and especially in the price point of like 175 to 325, if they have a pre-qualification and a pre-approval, go with the pre-approval.
That is some awesome information, Dan. Really appreciate you answering that for our viewers. The next question that comes up on Google when home buyers are wanting to buy a home, is there a best amount to put down for their loan in general? Like, should they put down 5, 10, 20%? Like, is there a best amount? And then why that amount may be better than others?
All right. The answer to that is how long you can be at the house. If you're not going to be at the house long, you want to have as little investment. If you're only going to be there a couple of years, 2 to 3 years, you're a new first-time home buyer, you want to get into the house with the least amount out of your pocket. You want to look at 100% loans. You want to look at low down payment, 3% home possible. If you want to be there for your ever home, the more down you put, there's 4 things that dictate your interest rate: the type of home, how much you put down, your debt ratio, and of course your credit score. Now, there's a little known trick that I show people. A lot of customers come to me and say, Dan, I want to put 20% down. I says, okay, why don't we put 18% down instead of 20 and buy out of the mortgage insurance for the last 2%? And they're like, why would I do that? You get a better rate. See, what most people understand on conventional loans, you actually get a better rate if you put 15 to 19% down, because the lender has some type of protection, and the rate actually bumps up at 20% down. And you can buy out the mortgage insurance, which is usually a very small amount, to buy out for that last 1 or 2%. And overall, it's a much better deal. And most lenders don't even know that exists. And I showed people, let them choose. Now, if you put 25, 30, 40, 50% down, no, you don't want to do it. But to answer your question, the best down payment depends really how long you be at that house.
Wow. That's some awesome information. You guys give Dan a thumbs up for that one. I've never heard that before. That's some amazing information. Wow. That is awesome. Really appreciate that, Dan. Another question that comes up with people is there a breaking point, or is there a best benefit point for differences in people's credit score? Like not talking about the minimum credit score, but talking about like if someone's at a 700, but they want to like do some sort of trick to get to 725, is that trick and that extra 25 points worth waiting, or should they just go ahead and move forward right now?
That is a very, very good question, and it depends on how much improvement you can have. And we use the what ifs. Actually, right before this call, I was on a lady. We did a what if scenario. She had a 612. We paid down a credit card. She now has a 680. In her situation, yes. So it really depends on the improvement. But what most people don't understand is unless you're putting 20% down, the increase in the credit score will affect the type of loan. The key point is 660. You always want to be over 660 because at 660, you can get mortgage insurance, and there are a lot of things below 660 that you take a lot of hits on. So if you can get first and foremost over 660, that's the key. The second thing is you have to analyze, okay, am I going to get 25 or 30 points? Will I change my rates? In most cases, not much. However, it'll lower your mortgage insurance. So what you have to do is people focus on the interest rate. And I tell them, you don't want to focus on the interest rate. You want to focus on the mortgage insurance because the higher your credit score, the lower your mortgage insurance. And I'll give you a good example. I have a lady, this particular lady at 680 has $119 on conventional mortgage insurance. And I showed her if we could get her score, we can do it now. But if we get her scores up to 721, it drops to $31. The rate
Wow.
changes only an eighth of a point.
That's $90.
Drops it. Yep.
Wow.
That's where a lot of people don't focus on. They focus on the rate. There's not that much of difference in the rate. The mortgage insurance is a different story.
That's over $1,000 a year. That's a car tag in Oklahoma a year.
I told her, do you want to buy the house now? We're ready. So she has the choice to make. And I showed her what she could do to get that extra points. It will take her 30 days. So now that's up to you, what you want to do. I think she's going to go ahead and buy the house, though. She wants the house.
Yeah, you don't want to miss out on it because we do have low inventory.
Absolutely.
Dan, if anyone has any questions and they got to jump off of today's video, what's the best way for them to get in contact with you?
My cell phone, 405-822-0141. Call or text me. Best way.
That's so awesome. That's so awesome. In case anyone's got to jump off the call, come back, watch it later on your lunch break, watch it on your drive home. But there's Dan's number on the screen, and he said 405-822-0141. 405-822-0141. The fourth question that comes up a lot when you're doing a Google search of what consumers have about getting a home loan in the Stillwater Oklahoma metro area is the affordability of the mortgage payment. Now, the government has certain ratios. The secondhand market has certain ratios for loan amounts. But I love your answer, Dan. You've told it to us before. What is your answer when it comes to affordability of the mortgage loan payment?
Number one question we ask when I do an interview, what is the payment you can afford? You never want the house to own you. Customers know what they can afford. Customers know their bills. They know everything. So the first question, in fact, here's what our interview is. While I got one, this is their interview sheet. It looks like it's not an application. Number one question, what is your desired monthly payment? And we focus in on that. This particular person, I'll give you, and this is normal. I'm not going to show you the name. They want a monthly payment of $1,400 a month. Great. What houses are you looking at? 280 to 320. I don't want to put any money down.
I don't think that works with today's interest rate, does it,
No,
Dan?
it doesn't.
Yeah.
But I say, okay, now what's more important? The 280, the 320, or the 1,400? The 1,400. Then I bring them in and say, this is what you're looking at. These are the programs you can look at. Now, can you qualify for the 320? In this particular case, they can. But you're looking at an $1,800 payment. Now they have a choice. Now they have a reality check. But I say, but you told me 1,400, so this is where So I always stay on the 14. I always go back because that's what they tell me, and that's what I focus on.
And that's so amazing. Like Dan said, you guys do not want to be house broke. The ratios that lenders provide, that the secondary market provides for qualification purposes, could be way more than like Dan always says, that you can afford on a month-to-month basis because you don't want to be house broke.
Right.
Fifth question that consumers have when it comes to mortgage loans and getting loans is how many different loan types out there? Because they get confused. They're like, what do you mean FHA? What do you mean conventional? What do you mean USDA? Like, how many loan types altogether are there for just knowing's sake?
I don't know how many there are. We have 32. So there's a
Wow.
lot. There are a lot of them, but they're all a variance of 4, really. They're all just different variants of 4: conventional, USDA, VA, and FHA. In those, if you know those 4, there's a lot of different loan types, different parameters inside of them, from construction to perm to buy down loans to I just tell people, it's really, you want to just focus on it. Number one, I always tell people, if you qualify for VA, that's your best choice. USDA is number 2, conventional is 3, in my opinion. Number 4 is FHA. So I just focus on those 4, and inside those 4, there are different parameters and different ways to do it.
Man, 32, that's nuts. Would never have guessed that at all.
Yeah.
A lot of people right now, Dan, they're worried about rates. They hear all this stuff on national news. They hear all this stuff, just a year ago, people were getting 3%. Now we're looking at 6, 7. I don't know what today's rate is, and I'm not trying to quote it. I'm not a lender, but what if something drastic happens? If the Fed, for some reason, comes out 6 months, 12 months later and says, hey, we're dropping it back down to 4% prime, and that brings down home loans. I don't know how all that works. I'm just throwing a scenario out there. How long does a consumer need to wait before they can actually refi their loan if better rates come up?
My standard answer on that is always the same. You need to drop your rate at least 1 percentage point and cut some of your term. If you can drop the rate, cut the term, and recuperate the cost to refinance in a short period of time, that's when you refinance.
So you're saying if they sign up for a 30-year mortgage today, right, and then next year, if they can drop the rate, did you say 1%?
At least 1%. As a rule of thumb, 1%.
So
and they
if
go
they
to a 25-year loan. So go 30, then drop it to 1, go to 25-year, because the biggest thing is you've got to recuperate the cost. And I'll sit there and show the cost. I say, here's your savings. And if it takes you 5 or 6 years to recuperate it, that's probably not a smart thing to do.
Because they might move.
Right. But if you can recuperate it in 3 years or less and cut term, that's a smart way to go.
Okay, so Dan, sorry.
You want to try to do both, cut rate and cut term. So you lower the payment.
Okay, that's what I was going to say. You're saying lower the payment and save money is what you're saying.
Right.
That's a good way to look at it.
If you cut the rate 1% and cut the term 5 or 10 years, then it's 3 wins. Lower rate, save money by cutting the terms, and you recuperate your costs in a short period of time. It's a win-win-win.
That makes absolute sense. That is a really good way to look at it. When it comes to buying a home, not only do they have down payment, but they have other costs associated with the payment. What's just a brief summary of those costs? Not like a detailed summary, but just a brief summary of things that consumers need to look out to when it comes to buying a home on the lender side of things.
The biggest thing is you have your prepaids, which are your homeowner's insurance 1 year up front, your mortgage, your insurance, your interest payment for whatever term of the month is left, and then your escrow. And then you have your closing costs. Your biggest closing cost, unfortunately, in Oklahoma is the title company. There's only 2 states that require full abstract. That's why our title, when people come here from California and stuff, first thing they say is, why is your title charges so much? Well, most other states, you close on a property report or an upgraded property report. Oklahoma, it's a full abstract. And that's the hardest thing to explain to them. We have to do the full abstract. The biggest thing I tell people is a lot of lenders are quoting ridiculous rates. They're quoting, like, I have one lender that they advertise 5.875. Well, that's with 2.5 points. And if you think about it, I tell people, you're only going to be in the house 3 or 4 years. You're going to pay all this money in points to save $100 a month, and it won't recuperate for 66 months. Because I just had that one yesterday. And they go, well, they didn't explain that to me. I said, well, now does it make sense? Do you want to spend all that extra money and you know you're not even going to be there that long? You can always refinance. Do it that way. That was the best thing. So it all boils down to, once again, how long will you be at the house, if it makes sense?
Wow. So title costs, about $1,200, depending on the title insurance.
Right.
1,200 to maybe $2,500. Because
Right.
title insurance, they've got awesome rate calculators online
Yeah.
at Old Republic, at Chicago Title, and First American. You can go look at their rate calculators for our consumers out there who want to do their own research, and you can just plug in 400,000. You're going to get a $1,500 title policy on average. Okay, look it up. I'm not a title guy.
No.
Verify, and then you've got processing charges, attorney fees, title report fees, and gap check. So that's where Dan's talking about expenses when it comes to title costs. So the appraisal is a big cost too here in Oklahoma. If you're doing rural properties, Dan, I think they're about $1,000 in rural properties right now. Is that a safe estimate?
It depends on your lender.
Okay.
Ours are $585 for appraisals.
Even in rural?
Yeah, $750 for VA. Our biggest cost is VA. VA, for some reason, really increased their appraisal costs. We don't know why, but our biggest typically is $585 as a general for a conventional or rural development or FHA, and then you jump up to $750 for a VA. I have no idea why.
Wow,
well, that's jumped up big time.
That's really good info to know. Really good info to know. Thank you so much on that. Another question that consumers have when it comes to buying a home loan is, do they have to get an appraisal? And I was blown away by this over the last couple of years when people were putting absurd amounts of money down. So something came up that answers this question that I'd never seen before. Do people have to buy an appraisal, Dan?
The answer is yes and no. And you're going to go, what? Well, more and more the research has been done, and the appraisers, of course, are not happy about what I'm about to tell you. That in a lot of cases, we get what's called a HIT or a waiver, appraisal waiver. And we submit it in, and the system says we don't need an appraisal. That we agree with the value. Because with technology today, we're seeing more and more appraisal waivers. Then my call goes like this. Hey, Josh, you don't need an appraisal. The system says you can save that money. You can pocket it. I still strongly suggest you get, an inspection, a termite. You don't need those either on most loans, except for a VA loan. That's a cost if you want to bear it or not. But according to our system, your value is absolutely fine. And with all the information and technology, they're spot on. And more, we're seeing appraisal waivers because they're spot on. And of course, the appraisers don't like it because they don't get anything. But it saves a lot of money.
Yeah, and there's situations too where a buyer knows that there were 5 other offers on this house. Like an appraiser on their side, it doesn't matter because it's the only home currently available that still fits their criteria. Because in Oklahoma, we still have low inventory in those lower price ranges, those $350K sub price ranges. And when it's an existing home and it's not a builder's home, there's going to be multiple offers because there's a lot of people still looking for those houses right now.
Absolutely. It's a beautiful thing. And you know what happens? Most people don't get the appraisal.
Moving's expensive. Yeah, moving's expensive. They could use that money. Yeah. The final question, Dan, and so let me premise this.
All right.
Does like if someone, I don't know, $400,000, 20 grand is 5%. Does it help them to save up till they have 40 grand, till they have 10%? Is there a difference in the scheme of things putting 5% down compared to 10% down? And you've kind of answered this, and I'm not trying to be redundant. These are questions that consumers have out there on Google.
Well, I can tell you that all depends back to question 1. What's your payment? What's your comfortability? What is your payment? If you want to put it down to get to the payment, do it. If that's your comfort letter, you want that house and you want that payment, there's 2 ways to do it. You can either put the money down or you can put it and buy the rate down. In most cases, putting the money down makes a lot more sense than buying the rate down. So it all depends. Is the larger payment actually help? Yeah. But really helps more is a shorter term, and I pound this over to people. I close a lot of 20 and 25 year loans. Why? The payment's not that much, but the amount of money you save and how quick you get rid of your mortgage insurance is astronomical for just a few extra dollars.
Wow. Yeah. I keep forgetting the shorter term is
Yeah.
way beneficial long term. Do you have a rough guesstimate on the savings difference over that term of the loan that you've
Oh, I
calculated for
know
people?
exactly. I know
Okay.
exactly. I actually do charts and stuff with people, and I always ask this question: if you have a 30-year loan and you have $100,000 loan, how long will it take you to get to 50,000 if you make every payment on time? I always ask people that, and the standard answer is 15, 17, 18, 20, and they're guessing. I said, well, 23 years, 8 months. They're like, what? Yeah, the first 10 years is interest. If you have a 20-year loan, how long does it take you? 11 years, 4 months. It's an average of $28,000 to $32,000 per $100,000 in interest savings between a 30-year and a 20-year loan. So if you have a $300,000 loan, that's over $100,000.
Wow.
And the
Wow.
payment's only about $270 to $300 a month more. But if the payment bothers you, don't do it. But if the payment doesn't, and in most cases, the interest is not tax deductible because of standard deductions. And I always tell people, don't listen to me. Go to your accountant or financial planner. And they come back 20 years.
Yeah. Wow. Wow. That's huge. That
Yeah,
is huge.
it's big dollars.
Well, that was the top 9 questions the
Excellent.
consumers have when it comes to borrowing money and getting a home loan in the Stillwater, Oklahoma metro area. Dan, what's the best number they could reach at if they have any further questions?
Once again, my cell phone, 405-822-0141.
Awesome, awesome, awesome. Viewers, thank you so much for today's video. Share it with all your friends who are also looking at buying homes in the Stillwater, Oklahoma metro area, and let them know they can give Dan a call too. He's here for all their financial needs. Subscribe to the channel. It's all about Stillwater, Oklahoma, Stillwater, Oklahoma real estate, living in, eating, drinking, playing, Stillwater, Oklahoma. Thank you so much, guys, and we will absolutely see you guys on the next video.
Thank you very much. Go Pokes.